Nio Stock is up 9.22% in the past week, but it is still down a little over 41% since its peak at the beginning of the year. Is it time to cut losses, take profits, or keep buying? Hello everyone, welcome back to the channel. Today we are going to talk about everything about Nio Stock and the potential future growth that they have. If you're new to my channel, welcome. Please consider subscribing and smashing that like button since it really helps the channel out. Also, I have a completely free Discord group chat, which the link for that is down in the description below. Now, I'm very sure almost all of you already know that the latest run on Nio Stock is because of Goldman Sachs. Why? Well, basically, they said that Nio could easily go up 66% as they updated the price target to $56 per share, which after this latest run, it is still a 53% gain. But there is something very important to understand here. FANG increases his sales estimates to account for the new ET7 vehicle, which the company previewed in January, but the delivery will start in 2022. This model is compared with Tesla Model S, but with a range of 600 miles and will be equipped with advanced self-driving, meaning that this price target strongly relies on their ability, on Nio's abilities to deliver the ET7 on time and at least meet expectations with this vehicle. We all know how volatile Nio stock is and how sensitive it is with any news, just like any other growth stock and even more any other EV growth company. Nio stock went up over 1,400% in 2020, got to $62 per share in 2021, and even though it has tried to recover from its previous drop, it has been dropping since then and for different reasons. The Chinese government situation, Chinese companies, Evergrande, EV volatility, and many more. But these analysts believe that a year of growth and stock declines have changed the valuation equation. Nio sales have continued to grow and Chinese EV penetration is now more than 10% of new car sales in China. The company's 2021 sales should come at $5.6 billion, and the stock's current valuation is much more attractive as Nio trades about 5 times estimated 2022 sales, as Nio is currently trading at $36.28 per share, with a market cap of $59.5 billion, and is expected to report a revenue of $9.46 billion by 2022, which is not longer trading at 5 times 2022 sales, but it is still trading at about 6 times 2022 sales. So it's still very nice. Now, they have now uploaded their delivery update for September and the whole third quarter. We already know that they delivered almost 8,000 vehicles in July, which was a growth of 124.5%. Then 5,880 vehicles in August, which was a slower growth of 48%, but still pretty nice, and delivered 10,628 vehicles in September, which was a growth of 125%, meaning that they ended the quarter delivering 24,439 vehicles for quarter 3, which was a growth of 100.2%. I do have to say that September was in an all-time high monthly record for Nio, which obviously is very impressive as they continue growing massively and they are just starting. Even with all the situation going around with the chip shortage and supply chain issues, which obviously makes it harder. Obviously, this kind of growth is both impressive and necessary, as people need to continue seeing this growth to continue paying a premium for this stock. Talking about deliveries and production, something that impressed a lot of people is that Tesla took 12 years to build 100,000 cars, while China's XPeng and Nio took about half that time, which obviously is impressive, but not the best comparison if you ask me. It is certainly impressive because it demonstrates the growth and the potential, the future potential of this company, but it is not the best comparison as when Tesla started, there was not much demand for electric vehicles. There was not a culture for it. Tesla created that culture and that normality. Yes, we have always seen EVs on the street and mostly in Europe, but Tesla created the culture, or was the one, in my opinion, that made people actually want to buy an electric vehicle. Why? If you ask me, it is because of the beautiful design in comparison to the old EVs that we used to see and the technology that they come with. Now, it's easier for newer companies, but don't get me wrong. They still need a lot of money and time and more to be able to get where Nio is, and even more to where Tesla is, as it is a very expensive industry today. But now it is easier to sell an electric vehicle than before. People used to be more skeptical or scared of electric vehicles than how it is right now. Now, talking about money that they will need, we all have seen that big electric vehicle companies need a lot of time and money to be able to overcome any surprises or challenges on the way. Let me tell you that Nio is a highly diluted company. Just on September 7th, they announced an offering of American depository shares worth up to $2 billion, which according to them, it will be used to strengthen their balance sheet and general corporate purposes, but that represented a dilution of about 3% at the moment, which, let me tell you something, I understand that sometimes companies need to do this to take advantage of the stock price or because they need more money to continue growing and innovating. Yes, definitely this money will help them continue growing as fast as they have been doing in the past years. I understand a lot of companies do this during the early stages, but you gotta understand how highly diluted Nio is. Obviously, they do this because they are not profitable and are not quite cash flow profitable, as they just turned cash flow positive last year, but it is not enough. There is a lot of speculation behind this dilution. For example, an article on Seeking Alpha explains that they might have done this dilution as they learned that their Hong Kong IPO would be delayed, as the company has reportedly run into some issues regarding users' trust holdings. They were obviously counting on more financing to come due to the dual listing, but have now been forced to wait longer for this to happen. Still, I understand that they have a strong cash position in their balance sheet, and they might just be taking precautions. I understand this is not a bad idea, or does not sound that bad, as they have a lot of growth potential with all their new products and projects, but it is definitely to have in mind, as a dilution is a dilution, but we gotta continue seeing such growth in the company to kind of balance itself. Now, talking about potential growth, it is huge that Nio has entered Europe through Norway, and that will be the door for them to spread across Europe. Obviously, this is no coincidence, as Norway is one of the largest EV areas, and it is one of the countries to go fully electric by 2025, which I believe was a nice strategy for from Nio to start with Norway. I understand that Norway might not be the #1 country in vehicle sales, but during 2020, 70% of all cars sold in Norway were electric. Now, remember how I said that it was going to be fully electric by 2025? Well, Norway is about to hit 100% electric vehicle sales early next year. Analysis shows that the last new petrol and diesel car sold in Norway will come as early as April 2022, 3 years ahead of the government target, which it is definitely not a coincidence that Nio has selected Norway as their first European point. And also this shows how big EV companies will be in the future, in the very near future. Now, Nio is trading at $36.33 per share with a market cap of almost $60 billion. It does have a nice price to sales ratio of 2.15, and obviously no PE, as they are not a profitable company, even though analysts estimates that they will become a profitable company in about 2 years. It is expected to have a growth of 120% for this year 2021 and 67.90% for 2022, which obviously will be a slowdown in growth, but it is something we gotta wait and see first how 2021 ends, as many things can happen in the short term, which is why I don't believe Nio is a short-term trade or short-term investment, even though it is up over 10% in the past 5 days, and Goldman Sachs have set or raised their price target to $56 per share. Nio is a highly volatile stock, and it can go down as fast as it goes up. Nothing wrong with that. It is kind of normal for growth companies, even more growth EV companies, and even more for growth EV Chinese companies. As we all know that everything that is going around in China affects every single Chinese company, just like in any other country. I do believe it is a great start for Nio to start in Norway. I don't believe it is an undervalued company, but don't see it as a massive overvalued stock either. It is kind of in the middle, and I believe they do have a nice potential long term. Obviously, we do have to understand the dilution and all the risks involved in this company, as they are in such early stages. Remember that they were near bankruptcy last year until an investment of $1 billion came in. Nothing wrong with that, but that might be one of the reasons of why they have been trying to have as much cash as possible, as they understood that this industry is very, very expensive, but they have now shown the potential growth that they have. Again, I'm not investing in this company right now, but I believe it could be a good long-term investment. Hear me out, long-term investment. If you understand the company, the risk, and everything, as their expected growth seems spectacular. Now, I can't tell you if you should sell for a loss or for a profit or buy more, because I'm no financial advisor, but I would sell this position for a loss if I see something in their fundamentals change, or if I would sell also if I believe my money will do better in other places. Now, I would hold my position if I believe everything is more than normal and more than okay, and would add to this position if I see the potential and understand the risk in this company and how volatile this stock is, as it is up a lot in the past week, but could drop massively next week, or it could skyrocket even more. Thank you, and see you next time.